So we're often asked about the flaws of index construction in the bond world. And when you think about when you build a bond index, you're by definition putting more bonds of the most indebted companies or issuers in there. So when you look at the Barclays Agg, the bellwether index that the majority of funds are benchmarked to, first you'll notice the Treasury component of the index has increased significantly over the last 10 years because the US Treasury has been running deficits and issuing more treasuries. So if you're indexing in the Agg, you're by definition lending more to the most indebted issuer, in this case the Treasury. Second, on the corporate side, one of the large components of the index, you're by definition lending more to the companies that have more weight in the index. And I like to think about an analogy here, right? If you ran a bank and you were the senior loan officer at a bank and someone walked into your door and asked for a loan, and your first and primary question then was, how much existing debt do you have outstanding? And if they had a lot of debt outstanding, you'd give them a big loan. If they had a little debt, you'd give them a little loan. If they had no debt, you'd give them no loan. That's what you're in essence doing when you're replicating a bond index. You're lending to the most indebted companies and not lending to the lowly indebted companies. We try to do almost the opposite of that. We're trying to find the companies that there's a strategic reason why they're adding some leverage to their balance sheet and debt to their balance sheet, and we're getting fairly paid for that. Oftentimes, the companies that are in the index have a structural advantage in that their bonds are in higher demand by index replicators and low active share active managers who are kind of hugging the benchmark. That gives them a financing advantage where their spreads are lower. Their bonds are more well known, their bonds are more well covered, certain people have to buy them in order to reduce their tracking error, and their spreads are tighter. That leaves, hopefully, potentially wider spreads on the bonds that aren't as covered, where an active bond manager can cultivate those spreads. There's been a big movement and big debate in the ETF world on the bond side about active versus passive. We actually think a lot of the flow that's going into passive has almost been inadvertent, where as ETFs began to rise in prominence, a lot of people knee-jerk reaction concluded it must be like equities where passive is the way to go. If you look at the empirical data, PIMCO agrees, it's been really hard for active equity managers to beat their median passive peer group. On the other side, when you look at bonds, the data is different. Over 2/3 of active managers have successfully beaten their passive median peer group. And a couple of reasons why bonds are different in that case. The market's just different, right? The equity market is incredibly transparent, much fewer issuers. The bond market is largely over the counter, tens of thousands of issuers. And at the end of the day, that creates structural inefficiencies in the bond market that a passive manager can't cultivate, but an active manager can. Second, if you look at the bond market, it's over $100 trillion globally. And roughly 50% of those bonds end up in hands of non-economic investors. And what I'm talking about there are central banks who need to buy bonds to manage foreign currency reserves, or buying bonds as part of their quantitative easing programs, or asset liability management driven investors who are buying a bond simply to defease a liability rather than buying and selling bonds in order to generate alpha. So the fact that 50% is being held in those hands creates an opportunity for us in the other 50% to extract alpha out of the market that's left out there.